Every morning, Martin sat by his window with a cup of coffee and a folded newspaper. At 68, retired from a long career in logistics, he liked to keep up with the world, even if it moved faster than he did these days. But on this particular morning, one headline grabbed his attention in bold letters: major tax changes coming for retirees. His heart skipped a beat. He'd worked hard to save for retirement, built a modest but solid nest egg, and budgeted down to the penny. He didn't like surprises, especially not the kind that could mess with his carefully planned numbers. He folded the paper and headed straight to his desk, pulling out a thick blue folder labeled Retirement Plan. Inside were years of statements, spreadsheets, notes from past financial advisors, and scribbled calculations he'd done himself. Martin had always taken pride in doing things right. He'd paid off the house, avoided debt, and maxed out his contributions when he could. But tax codes were a different beast. They changed often, and rarely in a way that made life simpler. Later that day, he called his daughter Claire, who worked in accounting. "I just read that retirement taxes are changing again," he said. "Do I need to worry?" Claire paused. "Let's sit down this weekend, Dad. I'll walk you through everything." On Saturday morning, they sat together at the dining table, laptops open, coffee cups steaming. "The first big change," Claire explained, "is that the required minimum distribution age is shifting again. It used to be 70 and a half, then 72, and now for some people it's moving to 75. That's good if you want to delay withdrawals, but it could also mean bigger taxable distributions later if your accounts grow too much." Martin nodded slowly. "So if I wait too long, I might have to take out more and pay more taxes." "Exactly," she said. "That's why we might want to consider small withdrawals now, even if you're not required to, just to keep your future tax bills lower." She pulled up a chart showing hypothetical scenarios. Martin watched as his estimated taxes changed with just a few percentage point shifts. "Next," she said, "Social Security taxation thresholds haven't changed in years, but incomes have. So more retirees are ending up paying taxes on Social Security because of inflation and cost of living adjustments." Martin leaned back in his chair. "I didn't realize that could happen. I thought I already paid taxes when I earned that money." Claire smiled gently. "You did. But once you start drawing it, the government checks your other income too. If it's high enough, like from your 401k withdrawals or investment income, they'll tax part of your Social Security as well." Martin's eyes narrowed. "So the better I plan, the more I'm punished." "It can feel that way," she said. "But the key is strategy, not panic." They talked about Roth conversions, how converting portions of his traditional IRA to a Roth IRA now could save him in the long run. Claire explained how spreading the conversion over several years might prevent a spike in his tax bracket. "And don't forget about Medicare surcharges," she added. "If your income's too high, your Medicare Part B and D premiums go up. That's not technically a tax, but it feels like one." Martin exhaled. "How is anyone supposed to keep up with all this?" "That's why I always tell people to treat retirement like a second career," Claire said. "You've got to manage your money actively, even more so now that there's no paycheck coming in." Martin chuckled. "I thought retiring meant relaxing." "Relaxing, yes. Ignoring, not so much." As they dove deeper into qualified charitable distributions and estate tax thresholds, Martin began to feel overwhelmed. But then Claire pulled up a short video from a channel she liked. "Hey, watch this one. It breaks it all down simply." Martin watched as a calm voice walked through the latest tax changes, using real-world examples. It clicked faster than the spreadsheet ever could. "This is really good," Martin said. "What's this channel?" "It's called Finance Family. They do a great job of telling stories that actually make sense of this stuff." He made a mental note. Subscribe to Finance Family. Maybe learning didn't have to be dry after all. Over the next few weeks, Martin began making adjustments. He set up a meeting with his financial planner to revisit his withdrawal strategy. He opened a Roth IRA and scheduled his first small conversion. He also recalculated how much income he could generate without triggering a tax on his Social Security benefits. He wasn't just preparing for changes, he was staying ahead of them. Martin's phone buzzed just as the video ended. It was a message from his friend Alan, another retiree in their neighborhood, who'd seen one of Martin's forwarded links from Finance Family. "You've turned into the retirement tax guru," the message read. "Got time for a walk?" They met up a little after lunch, strolling down the tree-lined sidewalks, both wearing light jackets as the spring breeze gently blew through the branches. Alan looked troubled. "I've been meaning to ask," he said. "What if you didn't do all this stuff early on?" "I didn't do any Roth conversions. Never thought about taxes until now." "Is it too late?" Martin gave a small smile. "It's never too late, Alan. But you do have to start somewhere. Even small shifts can add up." Alan sighed. "My tax bill was higher this year than expected. My advisor said my RMDs pushed me into another bracket. Felt like I was being penalized for saving too much." Martin nodded. "That's exactly how I felt when I first saw those charts Claire made for me. But it's not about regret. It's about taking back control. There are still options." As they walked, Martin shared some of the moves he had made. Donating directly from his IRA, adjusting the timing of withdrawals, considering income smoothing, even setting up a donor-advised fund for future giving. Alan raised an eyebrow. "Income smoothing." "Think of it this way," Martin said. "If you know your income will spike in certain years, like when your RMDs kick in, you can take a little more out now, at a lower bracket, and ease the impact later. Kind of like spreading peanut butter on toast instead of dropping it in one thick clump." Alan laughed. "That's one way to picture it." They passed by the community library, and Martin stopped to look at a poster for an upcoming retirement seminar. "You know, before all this, I thought being retired meant I could forget about money." "But you didn't forget it," Alan said. "You got better at it." Martin smiled. "Because I had to. We've got the time now. Might as well use it to protect what we've earned." That evening, Martin sat down at his desk again, looking over his projected numbers for next year. He realized there were still things to adjust. A small Roth conversion this year might avoid a future Medicare surcharge, and delaying Social Security another year could give him a better benefit. He emailed Claire with a few questions, bookmarked a new article, and scheduled a check-in with his advisor. For the first time in a long while, these financial tasks didn't feel like chores. They felt empowering. Then he remembered something Claire had mentioned months ago. How many retirees forget about inflation when thinking about taxes? While tax brackets do adjust, not everything does. Martin pulled out an old grocery receipt from just 5 years ago and compared it to the current prices. He shook his head. Same bag of coffee, double the cost. He updated his spreadsheet again, adding in a modest annual increase for everyday expenses. He also added a column for potential long-term care, something he hadn't considered deeply before. He thought about his brother, Peter, who had to move into assisted living last year. The cost had surprised them all. Peter's savings weren't built for that kind of pressure. The more Martin learned, the more he realized retirement planning wasn't a one-time thing. It was an evolving puzzle, one that required attention, patience, and a willingness to stay informed. But it wasn't just about tax brackets or deductions. It was about freedom, about making sure his money supported his life, not the other way around. On a sunny Thursday morning, Martin gave a short talk at the community center titled "What Retirees Should Know About Taxes in 2025. He brought charts, shared his story, and pointed people to videos and tools that had helped him. The room was filled with nods of recognition and sighs of relief. One woman approached him after the talk. "I wish someone had explained this to me years ago." Martin handed her a flyer with resources. "That's why I'm doing it now. So maybe someone else can start sooner than I did." Back at home, he reflected on how much had changed. He no longer feared tax changes. He was prepared for them. And even if new laws were introduced next year, he knew how to respond. With clarity, curiosity, and calm. He sat down, opened YouTube again, and smiled at the familiar blue logo of Finance Family. To everyone out there navigating retirement, don't underestimate the power of staying informed. A few smart decisions today can save you thousands tomorrow. If Martin's journey helped you think differently about your retirement, don't forget to like, share, and comment.